Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. Investing in international equity ETFs like VXUS is one of the simplest ways to diversify beyond the US market. These funds let you own hundreds or even thousands of foreign stocks in a single trade, spreading risk across regions and industries. With lower costs and easier access than buying individual foreign stocks, they're a practical choice for most investors. VXUS, for example, covers developed and emerging markets outside the US, giving you exposure to economies you might otherwise miss. Global diversification can smooth out returns over time, reducing reliance on any single country's performance. If you're looking to balance your portfolio, international ETFs are worth considering. What are international equity ETFs? International equity ETFs are exchange-traded funds that invest in stocks outside your home country, giving you exposure to global markets. Unlike domestic ETFs, which focus on US companies, these funds hold shares in businesses from Europe, Asia, and emerging economies, spreading your investment across borders. Many, like VXUS, are passively managed, tracking broad international indexes instead of handpicking stocks, which keeps costs low. These ETFs bundle hundreds or thousands of foreign stocks into a single trade, simplifying access to markets that might otherwise be tricky to navigate. For example, VXUS includes stocks from developed nations like Japan and Germany as well as faster-growing regions such as India and Brazil. You get diversification built in, without needing to buy shares in each country separately. Key features of international equity ETFs. International equity ETFs stand out for three main reasons. Broad diversification. They spread your money across countries, industries, and companies, reducing risk. VXUS alone holds over 7,500 stocks from nearly 50 countries. Lower costs. Many have expense ratios under 0.10%, far cheaper than actively managed mutual funds. VXUS costs just 0.07% annually. Tax efficiency. ETFs typically generate fewer capital gains than mutual funds, deferring taxes until you sell. Because they trade like stocks, you can buy or sell shares anytime the market's open, unlike mutual funds which price just once a day. How international equity ETFs compare to mutual funds. ETFs like VXUS offer several advantages over traditional mutual funds for international investing. Lower fees. Expense ratios are usually lower, saving you money long-term. Better liquidity. You can trade ETFs throughout the day, while mutual funds settle after hours. No minimums. Most mutual funds require an initial investment, but ETFs let you buy even a single share. If you want flexibility and cost efficiency, international ETFs often win out. Mutual funds might still appeal if you prefer automatic investing, but ETFs like VXUS make global diversification simpler and cheaper for most investors. Why invest in international equity ETFs? Adding international equity ETFs like VXUS to your portfolio isn't just about expanding your stock picks, it's about unlocking benefits that US markets alone can't provide. From lowering risk for geographic spread to capturing growth in faster-moving economies, these funds offer a straightforward way to think globally without the hassle of managing foreign investments yourself. Benefits of geographic diversification. Putting all your money in one country's market is like relying on a single engine to power a plane. If it fails, you're grounded. Spreading investments across multiple regions means a downturn in one area won't tank your entire portfolio. Here's how it works. Reduced volatility. When US stocks slump, international markets might hold steady or even rise, balancing your returns. Industry gaps filled. Some sectors, like luxury goods or semiconductor manufacturing, are dominated by non-US companies. VXUS gives you access to leaders you'd miss sticking to domestic stocks. Historical outperformance. Over decades, international and U.S. markets have taken turns leading. Holding both increases your chances of catching the upside. For example, during the 2000s, U.S. stocks lagged while emerging markets surged. Investors with global exposure came out ahead. Exposure to emerging and developed markets. ETFs like VXUS split your investment between two types of economies. Developed markets like Japan, Germany, UK. Stable, mature economies with lower but steady growth. These make up about 75% of VXUS. Emerging markets like China, India, Brazil. Faster growing but riskier economies, accounting for roughly 25% of the fund. The blend matters because developed markets offer reliability, think established companies paying consistent dividends. Emerging markets bring growth potential as rising middle classes drive demand for goods and services. For instance, India's stock market has outpaced the S&P 500 over the past 20 years. Currency movements add another layer. When the US dollar weakens, foreign investments and their dividends get a boost when converted back to dollars. It's an extra buffer against inflation at home. That's all for part 1. We've covered the basics, but there's more to learn. Stay tuned for part 2, where we'll dig into how to pick the right ETFs and build your global portfolio. See you soon. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.